Ever wondered why some people are financially successful while others struggle? The secret might just lie in a diversified investment portfolio. Simply put, diversification is the art of spreading your investments across a variety of assets and sectors. It's an age-old wisdom of not putting all your eggs in one basket. The reason? To manage risks and increase potential returns. See, investing is a bit like weather forecasting. It's unpredictable. One day it's sunshine and rainbows, the next it's raining cats and dogs, but by having a diversified portfolio, you're essentially preparing for all kinds of weather. It's your financial umbrella, raincoat, and sunscreen all rolled into one. It's about striking the right balance between different investments. That way, if one sector takes a hit, the others can help cushion the blow. So how can you build this diversified portfolio? The process can seem complex, but we'll break it down into manageable steps. First things first, understanding your risk tolerance is crucial. In the journey to build a diversified investment portfolio, gauging your comfort level with risk is a fundamental first step. Your risk tolerance is as unique as your fingerprint, influenced by a myriad of factors. Your age, for instance, plays a significant role. The younger you are, the more time you have to recover from potential losses, and thus, you might be more inclined to take on higher risks. Your income and financial goals also come into play. If you're aiming for an early retirement or saving for a major purchase, you might want to tread more carefully. And let's not forget the personal aspect. Some of us are natural risk takers, while others prefer a more cautious approach. There's no right or wrong here, just what feels right for you. Knowing your risk tolerance will guide your investment choices as you build a diversified portfolio. It's about finding the balance between risk and reward that best fits your personal financial landscape. Once you understand your risk tolerance, the next step is to diversify across different asset classes. Now, you may be wondering, what exactly are asset classes? Well, in the realm of investing, asset classes are categories of investments that exhibit similar characteristics and are subject to the same laws and regulations. Think of them as the main ingredients in your financial recipe. They include stocks, which are shares of ownership in a company, bonds, which are essentially loans you give to a government or corporation in exchange for periodic interest payments plus the return of the loan amount at maturity, and real estate, which can provide rental income and potential appreciation. But these are just the basics. There are also more complex asset classes like commodities, hedge funds, private equity, and even cryptocurrencies. Each of these asset classes carries its own risk and reward profile, and they often perform differently under varying market conditions. Here's where the magic of diversification comes into play. By spreading your investments across different asset classes, you can balance out the risks and rewards. When one asset class is down, another might be up. This way, you're not putting all your eggs in one basket, and it's not just about protection against volatility. Diversifying across asset classes can also give you multiple avenues for potential growth. It's like casting a wider net in the vast ocean of investing opportunities. Remember, the goal is to create a blend of assets that aligns with your risk tolerance and financial goals. Diversifying doesn't stop at asset classes, it goes deeper. Imagine this. You're not just an investor, but a gardener. Each type of asset class, stocks, bonds, real estate, and others, is a different type of plant. But even within these types, there's variety. There are roses and tulips, oak trees and pine trees, all with different needs and growth patterns. Just like in your garden, your portfolio can benefit from this variety. When we talk about diversifying within asset classes, we're talking about spreading your investments across different sectors, industries, or regions. For example, if you're investing in stocks, don't just invest in tech stocks. Consider healthcare, consumer goods, utilities, and other sectors as well. Each industry has its own set of risks and rewards, and by investing in a variety, you're not putting all your eggs in one basket. This principle applies to bonds and real estate too. Bonds from different issuers like government, corporate, or municipal bonds each have their own risk levels and interest rates. And real estate properties in different locations or of different types, residential, commercial, industrial, can provide different returns and risks. So diversifying within asset classes is like planting a variety of roses or a mix of oak and pine trees. It makes your garden, your portfolio, more resilient to changes in the market's climate. By diversifying within asset classes, you're spreading your risk even more finely, further safeguarding your finances. You've built your diversified portfolio, great, but the work doesn't stop there. Now it's all about maintenance, fine-tuning, and regular checkups. Just like a well-oiled machine, your portfolio needs consistent attention to keep it running smoothly. Why is this important? Well, the financial world is in constant motion. Market conditions change, new investment opportunities emerge, and your financial goals and risk tolerance may evolve over time. All these factors can affect the performance and suitability of your portfolio. Regularly reviewing your portfolio allows you to keep pace with these changes. It's like a health check for your investments. You're essentially taking the pulse of your portfolio, making sure it's still aligned with your financial goals and risk tolerance. So, how often should you review your portfolio? There's no one-size-fits-all answer to this. It largely depends on your individual circumstances, but as a general rule of thumb, consider a thorough review at least once a year. More frequent checkups may be necessary if there's a significant change in your financial situation or when the markets take an unexpected turn. Now, reviewing your portfolio isn't just about looking at numbers, it's about asking questions. Has your risk tolerance changed? Have your financial goals shifted? Are there new investment opportunities you want to explore? Are your investments still performing as expected? These questions can help you identify areas where adjustments may be needed. And what about those adjustments? They could be as simple as rebalancing your asset allocation, or as complex as changing your investment strategy. The key is to make informed decisions based on your current situation and future aspirations. But remember, while adjustments can be beneficial, excessive tinkering can be harmful. Frequent buying and selling can rack up transaction costs and potentially lead to poor decision-making. So don't be hasty. Be thoughtful, patient, and strategic. Remember, a diversified portfolio isn't a set-it-and-forget-it deal. It requires regular attention and adjustment. But with time and patience, it can pave the way to financial success. And that, my friends, is the true art of portfolio management. It's a journey, not a destination, and with each review and adjustment, you're not just maintaining your portfolio, you're sculpting your financial future.